How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. So report week is trugging right along. The first two episodes that we did this week, we reviewed the FDIC quarterly banking profile for the first quarter of 2025. Yesterday, we did the Federal Reserve's economic well-being of U.S. households in 2024. And today we're doing the OCC interest rate risk statistics report. I think people will find this interesting. If anybody is familiar in banking, basically all banks, I would say just about all banks, have what's called an ALCO committee, Asset and Liability Management Committee. And in that committee, one of the things they do is they look at reports, which they try to do a gap analysis, and they try to look at interest rate shocks. If interest rates go up or if interest rates go down, what could basically happen? Not only the impact on the banks, their net income, their net interest margins, their credit portfolio, but also something that's called their equity value. So we're gonna take a look at a couple of those terminologies here and a couple of the reports here as we bring this up right here. So I'm going to show you guys a couple of things here. The report itself is really not that interesting. It's a lot, it's a lot of numbers, visually not that great to look at. So I'm gonna basically just gonna show you guys like where to find it. We're gonna go through. I found somebody who did a great kind of quick overall summary of the report, which I thought would go down a lot easier. But okay. So this is the OCC's website. You can see right here that you could click on the report. This is the interest rate risk statistics report for the spring of 2025. The report presents interest rate risk data gathered during examinations of OCC supervised mid-sized and community banks and federal savings associations. The statistics are for informational purposes only and do not represent OCC suggested limits or exposures. But if you go to the website here, you could click on the download PDF. You get a copy of the full report, which is this report as such right here. Interest rate statistics report. It's a 19-page report. Now they go through each bank. So they go all banks. They go through asset size, banks with less than 100 million, banks with 100 million to 250 million, 250 to 500 million, 500 million to 1 billion, 1 billion to 10 billion, and then finally banks over 10 billion in assets. They also go by charter type, national banks, stock FSAs, mutual FSAs, minority depository institutions. Then they have something really good that we're going to take a look at, which is the glossary. Then they finish off with kind of like technical information, statistical populations and calculations. And then they have like an index of tables at the very end. So now, this has this whole kind of about this report. I wish that they gave a little bit more of a summary on this report, but this is effectively what it looks like if I blow this up here. So you can see here they have kind of the scenario of the rate shock over here. So down 200 basis points, down 100 basis points, and then up 100 basis points, up 200, up 300, up 400. And then you can see here kind of largest losses, 25th percentile, median, 75th percentile, and then largest gains over here. And what you're trying to determine ultimately by looking at these different shock scenarios is your bank asset sensitive or liability sensitive? Those are the two things that you're really trying to figure out. Like, in other words, if interest rates go up real quick, like what's going to happen if my assets are going to reprice quicker than my liabilities, then you're going to be asset sensitive. If your liabilities are going to reprice faster than your assets, you are liability sensitive. So, but you have to remember something. For banks, it's inverse. So the bank's loan is the asset. So when we talk about assets, we're talking about loans. So we say, all right, if the bank's loans reprice faster, they're going to be asset sensitive. If a bank's deposits for the bank, the deposits are the liability. So if the deposits reprice faster than the loans, then they're going to be deposit sensitive or liability sensitive. So just try to keep that in mind as we talk about some of this stuff. Now I want to pop over here. So I found this on LinkedIn. This gentleman named Ramesh Mishra. I'm hoping I'm saying that correctly, but he did a nice little breakdown here, real quick little breakdown. So, and I figured we'd go through this, and I figured that this might help make this a lot more sense. So NII, net interest income sensitivity. So smaller banks, less than 100 million, And mid-sized banks, 500 million to 1 billion, show greater net interest income volatility with significant losses and gains in upward shocks. In other words, if interest rates go up, they're going to have much larger losses. Larger banks, banks that are greater than 10 billion in asset size, are less sensitive, reflecting better risk management. I don't know if I necessarily agree that it reflects better risk management. I think it just reflects it's a larger bank. They have more assets, larger balance sheets. They have more revenue streams. They can kind of move things a little bit easier, so to speak, on their balance sheet. Again, I don't know if it's necessarily better risk management. I think it's just economies of scale. You're just larger. Again, like I said, you have more revenue streams. You can move the pieces of the board a little bit easier than smaller banks. I think it's more of that kind of thing. So this next thing is EVE sensitivity. So what is that? So now we're going to go back over to the report, and we're going to go down to our handy dandy glossary here, which has a great terms in it. So it's like just like a 2-page glossary here at the end, but has some great stuff in it. So what is EVE? So that stands for economic value of equity. So the EVE models measure the degree to which the economic values of a bank's positions change under different interest rate scenarios. So economic value models focus on a long-term horizon by capturing future cash flows expected from existing assets, liabilities, and off-balance sheet items. And it says, refer to this booklet, whatever, for more information. But here's the key thing. The people that really look at this economic value of equity, this is for the board, okay? This is really for the board of directors of the bank. They want to know, okay, what is the economic value of our equity? In other words, if you might be thinking about selling your bank sometime soon, you really want to know what is the economic value of our equity. So that's really where that keys in and what to look at. So, but what does it say though? So the EVE is highly sensitive to upward shocks across all bank sizes, with smaller and mid-sized banks facing extreme losses, up to 319% for 500 million to 1 billion banks. Larger banks show more stable EVE profiles. Bank size impact. So smaller banks exhibit higher volatility due to less sophisticated IRR management, while larger banks benefit from scale and resources. Again, I kind of disagree with that whole less sophisticated internal risk management. I think it's just larger banks benefit from scale and resources. That's all. This kind of they don't know what they're doing in terms of risk management. I don't, like I said, that's the one thing I don't really agree with. Charter and minority institutions. So mutual FSAs and minority depository institutions show unique profiles, with mutual FSAs more sensitive to upward shocks and minority institutions less exposed to EVE losses. And then we get to NMD assumptions. So again, what is NMD? So let's go back to our glossary here. So non-maturity deposit assumptions. So NMD assumptions are one of the most vital assumptions in an IRR model, because NMDs usually represent a large portion of the bank's funding base, and depositors' behavior can vary considerably. NMD assumptions are needed because changes in deposit pricing and balances are not contractually defined. As a result, models must incorporate behavioral assumptions for deposit accounts, including NMD repricing rates, which estimate the change in a deposit's pricing versus the change in market rates; NMD average lives, which represent the level of deposit runoff over a given time period. So again, non-maturity deposit assumptions, NMD. So basically looking at your core deposits, your savings accounts, your checking accounts, your customers, how sticky are they in your bank? And what are the odds that they're just going to get up and walk out at any given time? That's really what we're trying to gauge there. So what do they say there? Large banks assume more responsive deposit behavior, impacting IRR models, while smaller banks expect greater deposit stability. So what do we take away from that? basically smaller banks feel like their relationships with their customers are much stronger and that they see a lot of deposit stability. They don't see a lot of wackiness kind of happen. They're keeping up with prices as they need to, as far as like offering interest rates on CDs, savings accounts, money market accounts, things like that. Whereas the larger banks seem much more concerned with their deposit behavior. In other words, and again, a larger bank, if you're say you're $100 billion asset regional bank, maybe you've got 90 or 110 billion in deposits. You're probably going to be a little bit more concerned because your deposit fluctuations might vary a little bit more than say a $5 billion community bank. So that's kind of the takeaway there. So, and then he wraps up by saying this analysis highlights the need for robust IRR management. Don't disagree with that, particularly for smaller banks, to mitigate risks from rising interest rates, which pose significant challenges to both net interest income and EVE. So, very nice summary. I give this gentleman a lot of kudos. He did a great job summarizing this in a very short, succinct fashion. So that being said, let me just state a couple points here real quick. So first of all, what are the probabilities that interest rates are going to increase here? In other words, is the Federal Reserve going to come out and start increasing rates? I think there is you can never say zero, but I think there is a very low probability that rates are going to be increased by the Federal Reserve anytime soon. I think the Federal Reserve is standing pat right now, and the probability is much higher. I would say probably 60, 70, 80%, somewhere in that neighborhood, that within the next 6 to 8 months, the Federal Reserve will begin to start lowering rates, probably in quarter point increments, and bring it down by another 100 basis points or so. I think that is a more likely outcome over the next, say, 12 to 18 months. However, that being said, so I think there's a higher probability that interest rates are going to go down, and for most banks, that will be favorable to them. However, treasury rates are going up right now. So let's take a look at the 10-year treasury. So the 10-year treasury is going up. Is that a bad thing for banks? I think that's a critical question. And I would say no. I would say that was good. That would help banks with their net interest income, their net interest margin. Having a higher 10-year treasury is not a bad thing. What it does, though, it keeps rates higher. Like, in other words, you've got a residential mortgage rate right now pressing up around 7%. A lot of the commercial rates are probably anywhere in the neighborhood of 6.5 to 7.25 right now. So, and having those higher rates, that means more tepid loan demand, as we saw in some of the reports, like the quarterly banking profile, the economic well-being that we saw. Obviously, loan demand remains very weak or tepid, and while we have those larger rates, so while banks can probably do better with those higher treasury yields right now, it's gonna put a damper on loan demand, and that's the problem. So it's kind of a double-edged sword, if you will. But very interesting analysis. It's always imperative to, like I said, keep an eye on this and look at these interest rate shocks. Determine if you, again, like I said, in most banks, they're going to do this report. This report is more for the banking industry in general. Most banks are going to do this on an individual basis and are going to, break it down for, what happens to our particular bank if interest rates go up or down, and looking at that gap analysis, looking at the different interest rate shock scenarios, and trying to determine what's going on, and then looking at their EVE and their NMD to see what could potentially go wrong there. So, and again, these are great things, great conversations, and this is really where you get into the real inner workings of a bank and how banks manage their balance sheets, which is why I really like looking at this stuff and really like talking about it. So, but with that being said, I'm going to wrap up here by saying, if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on Rumble, YouTube, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, remember to check out some of the other content on the channel. I hope everyone has a great day out there, and I will see everyone again real soon. Thanks a lot.